Good morning. Thank you for joining this morning's Q&A session, and we're going to go over some information such as the Roth Solo 401k, as well as the $1,500 auto contribution credit that's available for new plans and can be added to existing plans. Existing plans would be clients that are either restating from another plan provider to our plan, such as from Fidelity or Schwab or another self-directed solo 401k plan document provider, as well as existing clients that opened the solo 401k with us prior to December of 2023. Those type of plans would need to be updated for the auto contribution credit. That being said, you can always join the conversation on our community, which is mysolo401k.net/my community/forums. That's the address to get to the actual forums. We get a lot of good forum posts out there. We also have over 30,000 members on that community. Also, we have a whole video library there, and many professionals in the industry, from CPAs to attorneys to advisors, have posted many blogs out there in the community, really good articles that deal not only with retirement accounts, but also planning, whether it's retirement planning, life planning, estate planning, trust planning. So take a look at those. Let me send over the link to that community page as well. Okay. We also have a good artificial intelligence page that goes over solo 401k plans, business financing, aka Rob's 401k plans, as well as Checkbook IRA, aka IRA LLC. Let me send over a link to that. I'm also going to send another link out that compares the auto contribution credit with the tax credit. I know both of those get confused, as one applies to the solo 401k and the other does not. The one that applies to the solo 401k is the auto contribution credit, which is the $1,500 amount over 3 years for a total of $1,500. So $500 year one, $500 year two, and a final $500 in year three for a total of $1,500. So I'll send over that link here in a moment as well. Let's see here. We're also going to go over the auto contribution credit at a high level today. And again, we're also going to talk about the Roth Solo 401k and also answer some live questions here on the dashboard. So here's a good write-up that we did as a guest post on the White Coat Investor. It's a really good one. You should read that and pass it along to your CPA, as he or she may not be aware that the solo 401k plan qualifies for the $1,500 auto contribution credit, which is a dollar for dollar credit, which means it reduces your taxable business taxable income dollar for dollar. So take a look at that. And again, we'll touch on that a little bit more too here later on. So let's go back here. So we offer a self-directed solo 401k that comes with checkbook control, wire control, that allows you to invest in not only equities, whether we're talking about traditional stocks, to index funds or mutual funds or exchange traded funds to alternative investments such as cryptocurrency, real estate, precious metals, promissory notes, tax liens, and so on. And the whole checkbook wire control piece just simply means that you can place an investment in a type of alternative investment, such as precious metals and real estate, for example, by writing a check or by wire. For example, many of our clients use Fidelity to hold the self-directed solo 401k funds with checkbook control that we offer. So Fidelity will issue a checkbook. Most of our clients don't even use that checkbook, so it just collects dust. Most of them will place that alternative investment by wire. And some of them may just invest in equities for now, and later on, they find a good deal out there in some type of alternative investment, and they'll go ahead and make that investment by wire. So with the solo 401k plan offered by our company, it comes with checkbook control. You can also invest in equities. It also allows for participant loans where you can borrow 50% of the balance not to exceed $50,000. It comes with that $1,500 auto contribution credit for new plans that were established January 1st and after of 2024. From an eligibility perspective, not everybody qualifies for a solo 401k. As a matter of fact, you need to be self-employed and not have any non-owner W-2 employees in your business. So obviously, if it's an S corporation, you would be a W-2 employee, but you're also an owner. There's also the spousal exception where the spouse can also participate in the plan if he or she is also working in the business. That doesn't mean she has to be an owner in the business or he has to be an owner in the business. So you cannot open a solo 401k if you employ a W-2 employee that works 1,000 hours or more, unless he or she is also an owner in the business. That's why it's often called an owner-only solo 401k plan. As a matter of fact, let me send over the IRS page that talks about owner-only solo 401k plans, which is another way to refer to a solo 401k. Other names used to describe a solo 401k plan is solo K, individual 401k, one participant plan. So it all means the same thing. Sometimes you might see it denoted as a 401k profit sharing plan. So there's that IRS link to that page that talks more about the solo 401k. But again, you have to be an owner-only employee, not have any full-time W-2 employees in order to qualify for a solo 401k plan. Now, we also want to talk about Roth solo 401k contributions. On our last presentation last week, we talked about the Mega Backdoor Roth solo 401k. And you can actually access that webinar on our homepage. It's on our homepage at the very bottom. So, but today we're going to hone in on the Roth solo 401k. So what's interesting about the Roth solo 401k, especially with the passage of Secure 2.0, the Act, Secure 2.0 Act, is that now you can also make Roth solo 401k contributions at the employer level. So it used to be you could only make them at the employee level, so that salary deferral. So, but now you can choose to do both. Make them as employee Roth solo 401k contributions or as employer Roth solo 401k contributions. Now, most of our clients don't really make the contributions as employer Roth solo 401k contributions because most of them like to utilize the mega backdoor strategy, which is a dollar for dollar contribution. Whereas the employer contribution is a percentage based. So for instance, if you're an S corporation and you want to do an employer Roth solo 401k contribution, you can do 25% as an employer Roth solo 401k contribution. So if your W-2 wages are $100,000 for the year, then you could do 25% of that as an employer Roth solo 401k contribution, meaning $25,000. Well, if you do it as a voluntary after-tax contribution instead, you don't have to do it as a percentage. Therefore, it takes less W-2 wages to do the mega backdoor, which ultimately gets converted to the Roth Solo 401k. So using that same $100,000 example, instead of doing a 25% employer Roth Solo 401k contribution, you could just say, hey, I'm going to go ahead and do a 70,000 voluntary after-tax solo 401k contribution, and then you can immediately convert that to the Roth Solo 401k. Similar, instead of reporting 100,000 of W-2 wages, you could report just $70,000 of W-2 wages, and then you could contribute the entire 70,000 as a voluntary after-tax solo 401k contribution, and then immediately convert it to the Roth Solo 401k, and we're talking about 2025 contribution numbers here. So again, we're talking about the employer Roth Solo 401k contribution. Now, if we're talking about the employee pre-tax contribution, the employee Roth contribution, that there, it's dollar for dollar. So $23,500 if we're talking about an S corporation. So you would just need $23,500 to make an employee Roth Solo 401k contribution of $23,500. Of course, if you also want to make profit sharing contributions, you're going to need more than $23,500 to also maximize profit sharing contributions, because you can't contribute more than you report in W-2 wages. So, in short, the solo 401k plan does allow for employer Roth solo 401k contributions as well as employee Roth solo 401k contributions. For the catch-up contribution, that catch-up can never be deposited as a voluntary after-tax contribution. That can only go in as an employee Roth solo 401k contribution or as an employee pre-tax contribution. Since we're talking about the Roth Solo 401k here, many of our clients will choose to do the catch-up amount of $7,500 if you're age 50 or older as a Roth Solo 401k contribution. So there might be a situation where you do the mega backdoor where you contribute the entire $70,000 as a voluntary after-tax contribution, and then you also do the $7,500 catch-up to the Roth Solo 401k, and then you end up with $77,500 in your Roth Solo 401k for the tax year 2025. Then there's also that super catch-up effective for 2025 for those that are a certain age 60, 61, 62, or 63 here in 2025. So if you fall under that age there, instead of doing the $7,500 normal catch-up contribution for those age 50 or older, you can do the $11,250 catch-up instead. That's known as the super catch-up. So here are some notes regarding the Roth Solo 401k plans. You can only make the $7,500 catch-up contribution if age 50 or older in 2025. Of course, we have many clients that have not contributed yet for 2024. So again, we're talking about 2025 contribution limits here. You can still contribute for 2024 as well here in 2025 by your business tax return due date plus timely filed extension. So don't get confused there. And then, as we just talked about, in 2025, if you are age 60, 61, or 62, you can do that super catch-up contribution amount of $11,250 instead of the $7,500. You can do both, but you can do one or the other. And then another key item here is that Roth Solo 401k contributions are not restricted by the income limits like Roth IRAs are. Roth IRAs, not everybody can contribute to a Roth IRA. That's why many will do a backdoor Roth IRA where they'll make a non-deductible IRA contribution. Well, those income limits don't apply to the Roth Solo 401k plan. Of course, again, you got to have the necessary self-employment income to justify the contribution, but the point of that last bullet point there is to differentiate how Roth IRAs are subject to your adjusted gross income limits, but solo 401k Roth contributions are not. Now, those that decide to make Roth solo 401k contributions, it's important to understand that you need to have separate holding accounts under the plan, that is, brokerage accounts or bank accounts to hold those different source of funds. So this slide here, we're talking about a one participant plan, where just one participant is participating in the plan, and this participant has decided to make all three types of contributions, that is pre-tax, Roth, and voluntary after tax. Therefore, you would need at least 3 bank accounts or brokerage accounts opened up to hold each of those source of funds, because a solo 401k is a defined contribution plan. You have to segregate each source of funds. So that there is an example. So each bank or brokerage account would be titled in the name of the 401k, aka trust. The solo 401k is a retirement trust. It would be nicknamed pre-tax in parentheses for the pre-tax solo 401k bucket. Roth would be the nickname for the Roth solo 401k bucket, and after tax, or you can add the word voluntary after tax, would be used as the nickname for the voluntary after tax bucket. So that's an example of 3 separate holding accounts if it's a one participant plan. If we're talking about 2 participants in the plan, now we're talking about 3 additional brokerage accounts. It's going to be a total of 6. So that's because we have 2 participants in the plan. So for instance, your spouse may also participate in the plan if he or she is also doing self-employment activity. So it would be 3 additional holding accounts for the spouse. So 3 for you, 3 for your spouse. Each would be pre-tax, Roth, and after-tax. So you would each have a separate pre-tax, Roth, and a voluntary after-tax. Let's see here. Now, like I said earlier, I want to touch on that $1,500 auto contribution credit. And I had sent over a link earlier. Here it is, that compares the auto contribution credit with the tax credit. Now, this slide refers to it as a tax credit. It's technically the auto contribution credit. So solo 401k plans qualify for it. You're not required to make contributions in order to qualify for that auto contribution credit, which is great. That way, in some years, you may decide that you don't want to contribute to the plan, or maybe you didn't have enough self-employment income to contribute. That doesn't mean you're not going to qualify for that $500 per year auto contribution credit spread out over 3 years for a total of $500. So for example, if you open a plan this year in 2025, this would be the first year that you would qualify for that $500 part of that credit. And then you would qualify for another $500 amount next year in 2026, and a final amount in 2027 for a total of 3 years. And you would file Form 8881 to each year to claim that $500 credit. And again, if you're an existing client with us before December of 2023, your plan would need to be amended to allow for the auto contribution credit. And you can submit a support ticket if you want that added to your plan. Let me send over a link to our support ticket page. Okay, so a couple more slides here, and then we'll start answering some of your questions here on the chat. So when you open a solo 401k from my solo 401k financial, our flat annual fee of $125 is going to cover not only the fee for being the plan document provider, but it will also cover the filing of Form 1099-R and Form 5500 Easy. Of course, we don't have access to your money, so you need to make sure you let us know when you need that 1099-R and 5500 Easy. So for those who timely request those returns there, we'll gladly prepare them for you and file them for you. Now, the Form 5500 Easy only applies if the full market value of your solo 401k plan, including all of the funds in your plan and all participants' funds in the plan added together, are greater than $250,000 in value. So if the plan value is it's over $250,000 as of the end of 2024, for example, a Form 5500 Easy will need to be filed with the government by July 31st of this year. So if you timely request that, we'll prepare that for you and have it ready for your signature electronically. It'll get filed electronically with the IRS. Now, Form 1099-R, those apply when you make a distribution or if you process a conversion, whether it's pre-tax or a voluntary after-tax conversion. We also will assist clients in transferring IRAs and former employer plans to the solo 401k. That's both for new clients and existing clients. Some clients decide to transfer IRAs and former employer plan funds later to the solo 401k. So we'll help by filling out those type of forms. We'll also provide loan documents if you want to take a 401k participant loan. The plan does allow for that, so we'll draft those loan documents upon your request. That's where you can borrow from your own retirement plan. You pay back the interest to the plan. That doesn't go to us or the bank or the brokerage firm. You're paying your own plan back. You can borrow 50% of the total 401k balance, not to exceed $50,000. Therefore, to borrow the full $50,000, you're going to need at least $100,000 value in your plan. And if your spouse also participates in the plan and he or she also wants to borrow from the plan, he or she is going to need at least $100,000 value in solo 401k funds in order to borrow an additional $50,000. Again, our plan does come with the $1,500 auto contribution credit. All right. So that being said, as I mentioned earlier, you can follow the conversation on our community, mysolo401k.net/my-community/forums. Okay, let's turn over to some questions here. All right, I got a question here from John. Good morning. I have a small consulting services business, and I also work as a W-2 employee. I am currently maxing out my 401k with my employer. My profit from the consulting business is around $20,000, and my annual W-2 wages are about $60,000. What is the maximum amount I can contribute as after-tax contribution to my solo 401k? Well, so what's great about the solo 401k is that you can contribute to it even while also contributing to your daytime employer 401k as long as you're also self-employed. So assuming that, well, which it looks like it's the case, but as long as your employer plan is not a 403b, because that throws a wrinkle into the equation as far as being able to maximize solo 401k contributions. But since we're talking about a full-time employer 401k, that's not going to muddy up the waters regarding being able to maximize your voluntary after-tax solo 401k contribution. Reason being is that contributions to your daytime employer, whether it's employer or even voluntary after-tax contributions to that full-time employer, will not impact your voluntary after-tax contribution to your solo 401k plan. Therefore, if you have W-2 wages from your self-employed business, which it sounds like it's either an S corp or an LLC taxed as an S corp, of $60,000, and we're talking about 2024 contributions, you're going to be able to contribute all the way up to the overall limit for 2024 of solo 401k contributions, which for 2024 is, pull up that amount here. is $69,000. Well, you can't contribute more than you make. So in your case, you're going to be able to contribute the entire $60,000 as a voluntary after-tax contribution if you report $60,000 of W-2 wages for your self-employed business, S Corp or LLC taxes and S Corp, even if you've already maxed out your daytime employer 401k contributions. So that's what's great about the mega backdoor. It doesn't matter whether or not you've already maximized your contributions to your daytime employer 401k, you're still going to be able to contribute up to that overall limit of $69,000 for 2024. Of course, you would need at least $69,000 of W-2 wages to do so from your self-employed business. And then, of course, for 2025, the overall limit is now $70,000. So if in 2025 you report at least $70,000 of W-2 wages from your self-employed business, that's taxes and S Corp, then you can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution, and then turn around and convert it to the Roth solo 401k plan or the Roth IRA. So yeah, it's a very good deal that Congress still has going on. Hopefully it'll continue for the foreseeable future. Okay, another question here. Can I use my W-2 wages to fund the after-tax bucket? Is there a way to automate the mega backdoor Roth process once I have contributed to the after-tax bucket? I recently applied to open a solo 401k with Schwab. Should I cancel that account? So you can only contribute to the solo 401k plan based on your net self-employment income from your self-employed business. You can't use W-2 wages from your daytime employer. So if you also have a side business and that side business is taxed as an S Corp, then yes, you would pay yourself on a W-2 from that side business, provided you're doing the work and you're getting paid to support those wages. And then you would contribute to the solo 401k based on those W-2 wages. You could make voluntary after-tax solo 401k contributions to the solo 401k plan and then convert it to the Roth solo 401k or the Roth IRA. Now, many of our clients that have an existing solo 401k at Schwab, they will convert that Schwab solo 401k plan over to our solo 401k plan, and we'll help them to use Schwab to continue to hold those solo 401k funds by moving those existing Schwab solo 401k funds over to our plan. So we would help you to open up new brokerage accounts at Schwab, and then subsequently to transfer those existing Schwab solo 401k funds, including securities internally in kind, over to this new solo 401k. That's called a restatement. Now, if you have not opened the solo 401k plan yet, then obviously that would not be a restatement. You would open a solo 401k fresh for the first time, and you would complete our open account application, which applies whether or not you're restating an existing Schwab solo 401k plan over to our plan, or if you're opening up a plan up for the first time. As you know, Schwab solo 401k plan does not allow for voluntary after-tax solo 401k contributions. Let me send over a link that compares the difference between a solo 401k provided by Schwab and a solo 401k provided by my solo 401k financial. So don't get confused between the two, because again, with our solo 401k, it allows for voluntary after-tax contributions, and we can help you hold the funds for the plan that we offer with the voluntary after-tax feature over at Schwab. Here's that link that compares the two. The solo 401k offered by our company versus one offered by Schwab. I like to refer to it as a solo 401k by Schwab, and then a self-directed solo 401k. We like to add self-directed to the solo 401k when we're talking about a solo 401k offered by our company. Excuse me. Okay, let's move on to the next question here. But yes, we would guide you through the whole mega backdoor setup, contributions, conversions, and we would end up we would finish that up by issuing the 1099-R to report the non-taxable conversion. When you convert voluntary after-tax solo 401k funds to the Roth solo 401k, you want to do it immediately so that there are no gains. Therefore, there won't be any taxes due on that conversion. Let's see here. So I've got a gentleman here saying I have a very specific question. I have completed my solo 401k process and have my plan in place for 2024. I am self-employed, single, S Corp. I have no other income or plans and no pre-tax 401k. I want to max my Roth through the Mega Backdoor Roth. I'm paying myself $48,000 per year and have 128 to 150,000 in profits distributed to me. I'm 61, turning 62 this next month. What is the max I could contribute for 2024 and then 2025? Should I raise my salary? So, since you're an S corp, contributions are going to be the contributions will be based on your W-2 wages. So, if you want to max out your Mega Backdoor for 2024, the overall contribution limit for 2024 is $69,000. Therefore, you also qualify for the catch-up of $7,500 since you are age 50 or older in 2024. So you would need at least 69,000 plus 7,500. That would be what, $76,500. You're going to need to report at least $76,500 of box 1 W-2 wages. Then you're going to be able to contribute $69,000 to the voluntary after-tax solo 401k plan, and then you're going to contribute the $7,500 catch-up to the Roth solo 401k bucket. So again, it goes back to that slide I was sharing with you earlier that talks about how you have to segregate each source of funds. Let's see if we can find that slide here. So here it is, one participant plan. You're going to need at least 2 buckets, aka 2 brokerage accounts, 1 Roth and 1 after tax. If you're only going to make Roth and voluntary after tax contributions, you might as well open up the pre-tax one too, in case you want to transfer IRAs for former employer plans, or even make a pre-tax contribution this year or next year. But you would need separate brokerage accounts for each source of funds, after tax and Roth there, for example. Now for 2025 contribution limits, it would be the similar, it's a similar exercise with regards to how much you can contribute. Now the overall limit increased from 69,000 to 70,000 for year 2025. So let me pull up your question here. So you're going to need at least, well, and you actually qualify for the super catch-up since you're age 60 or older. I mean, well, let me clarify. So the super catch-up again is for ages 60, 61, 62, and 63. Since you fall within that range, instead of doing a $7,500 normal catch-up contribution, you're going to be able to do that super catch-up of $11,250. See if I can pull that up here. Remember we went over that slide earlier? Let's see, where's that slide at? Right here. Anyone that's age 60, 61, 62, or 63 in 2025, not 2024. So for 2025, you get that $11,250 catch-up. So therefore, $70,000 is the overall contribution limit plus $11,250. We're talking about a total contribution amount of $81,250. Therefore, you're going to need at least you're going to need to report at least $81,250 in box one of your W-2 for 2025 if you want to contribute that full amount. So the 70,000 would go to the voluntary after-tax solo 401k bucket. That $11,250 would go into the Roth solo 401k bucket. All right, so hopefully that answers the question there. So in short, it's got to be based on your W-2 wages. You got to pay yourself in order to contribute. What else do we have here? Give me a moment here. It's got a lot of questions coming in here. So looks like we're starting off with Monday with a bang here. Now, keep in mind, we're going to have another webinar today at 1 p.m. Pacific time. So if we don't finish going over your questions here, you can join again at 1 p.m. Pacific time, and we'll answer more of your questions there. Oh, let's look for another question here. Here's a nice comment from an existing client about our services and these webinars. We appreciate the good feedback. We do 2 of these a day. We like to call it 2-a-days. I know football season, we're in the playoffs now, but we like to call it 2-a-days. So one at 10 a.m. Pacific time and one at 1 p.m. Pacific time. So looks like we got a question here. As I understand that the employee bucket max out at 23,000 or so. The employee bucket max is the lesser of 20% of self-employment earnings, net 1/2 of self-employment tax. So that's true if it's a business that's taxed as a sole proprietorship or a partnership, not as an S corporation. That's one of the advantages of having a self-employed business as an S corporation, is that you don't have to subtract that 1/2 of self-employment income from your W-2 wages when doing the calculation for the solo 401k contributions, which means it takes less self-employment income to maximize your contributions, and therefore you have to pay less payroll tax, so less Social Security tax, and so forth. So let's see, and the voluntary after-tax bucket max is 69,000 minus the sum of what you contribute to the other 2 buckets. So those other 2 buckets you're referring to as the voluntary, it's the pre-tax bucket and the Roth bucket. Assuming I understand correctly, what is the point of ever using the employer bucket? It seems like it forces you to have higher self-employment earnings. No, you're not missing anything. So number one, just because you have separate holding accounts, aka buckets, that is pre-tax bucket, Roth solo 401k bucket, and voluntary after-tax bucket, that doesn't mean that you have to actually make those contributions. So it's just nice to have those buckets, and keep in mind that these buckets are already built into the plan. So they can always be added later if you decide you want to do one type of contribution, or they can all be opened up at once. There's no issue there. But just because you have separate holding accounts for each source of funds doesn't mean you have to make employer contributions, or on the flip side, Roth contributions or voluntary after-tax contributions. And if we're talking about a sole proprietorship, all 3 contribution types, whether we're talking about pre-tax, Roth, or voluntary after-tax, those are always going to be based on your net self-employment income, Schedule C, line 31. That's going to be the starting figure. And then we have to subtract 1/2 of self-employment income tax from that line 31. And our calculator, our solo 401k contribution calculator, will actually do that math for you. So if you already know what line 31 of your Schedule C is, you would simply, let me send over a link to our online calculator. You would simply plug in that figure to our calculator, and then it automatically deduct that 1/2 of self-employment income tax. Let me find that. Let me send you that link right now. So there's that link there. So to the calculator. Now, if and that's an example if we're talking about a sole proprietorship. If we're talking about a partnership, then it's going to be based on your Schedule K1. And partnerships are subject to that 1/2 of self-employment income tax reduction as well when performing the solo 401k contribution calculation. So if your business is taxed as a partnership, you're going to want to look at line 14, code A of that Schedule K1. You would plug that figure onto our online solo 401k contribution calculator, and it'll do the math for you. If it's an S corp, you would plug in the W-2 wages, box 1, onto the calculator. Now, one good thing about our calculator is that it's been updated for that super catch-up contribution amount, that $11,250 amount. So take a look at that. Okay, let's see what other questions we have here. Let's see here. Let's find another question here. Follow-up question. My accounts are at Fidelity. Do I need to achieve this, and what is the process of making contributions? Yes, you can make contributions directly into those brokerage accounts for the solo 401k plan that we provided. You can actually make those contributions electronically by ACH, where you link your business bank account to those Fidelity brokerage accounts under the plan that we offer. Here's a link here that talks about how to fund those Fidelity non-prototype brokerage accounts for a plan offered by my solo 401k financial. So you can do it electronically. There's that link there. Let's make sure here. Let me go back here and get the right. Yeah, that's the right link there. So take a look at that. What else here? Let's see. Give me a moment here. Let me pull up another question here. So 2024 is done. So what is my max 48K and W-2 salary? So if you report 48,000 of W-2 wages for 2024, you're going to be able to contribute that entire $48,000 as a voluntary after-tax solo 401k contribution, because it's a dollar for dollar amount when we're talking about an S corporation where you don't have to subtract 1/2 of self-employment income tax. So if you report $48,000 on your W-2 for 2024, and you have not made any other contribution to your Roth solo 401k or pre-tax solo 401k, then you can contribute that entire $48,000 as a voluntary after-tax solo 401k contribution. And then immediately, you don't have to wait. You can immediately convert it to the Roth solo 401k or to the Roth IRA. You get to choose. Okay. Calculator says 42,500. Is that because of the employer deduction that's not applicable? Let's see. I think you say you're an S corp. Is that right? So let me plug that number in here. So let me plug that in for 2024. Let me go to our calculator here. Give me one moment here. Calculator. So I'm going to plug in 48,000 is what you had mentioned. So on $48,000 of W-2 wages for 2024, you're going to be able to contribute. Let's see what it says here. So yeah, what the calculator is doing, that's a great question. So what the calculator is doing is that it's breaking down the employee contribution, which is 42,500, is also giving you that employer profit sharing contribution. However, because you're solely making voluntary after-tax solo 401k contributions, you're going to be able to do that entire $48,000 as a voluntary after-tax contribution. Unfortunately, our calculator is not smart enough to break down the voluntary after-tax solo 401k contribution. We've been trying to figure out how to do that, but we haven't been able to figure it out, and we don't know of any other calculator in the industry that can do solely a voluntary after-tax solo 401k calculation. That's why it's important to understand what the rules are for the voluntary after-tax solo 401k contributions. That is that it's a dollar for dollar amount. So therefore, as long as you report that 48,000 of W-2 wages for 2024, you can contribute that entire 48,000 as a voluntary after-tax contribution, and you would therefore forego making any employee contributions as well as any Roth solo 401k contributions, since you will have used the entire 48,000 for the voluntary after-tax contribution amount. All right, I think that about does it for today. Thanks again for joining. We're going to have another one of these today at 1 p.m. Pacific time. Until then, make it a good Monday. Bye-bye.